I love this quote. Diversification is protection against ignorance. This is a very powerful quote, which means that you should always diversify if you're not 100% sure of the investment that you're making. In this case, diversification acts as a hedge for not knowing enough or not knowing everything about this certain investment here. In other words, if you're not sure which horse is going to win, you make sure that you bet on many. That way, your chances of winning goes up. I think everyone should live by this if you want to invest smart, and I'm a very big advocate for diversification. And thank you, Martin, so much for sharing this. And one thing that I would mention about this, if you're investing in Kenya without a strategy, or you're investing in a single investment, then you're putting all your eggs in the same basket, and you need to know diversification is not just smart, it's about survival. This is how you survive in the investment space. We have seen big companies or institution corrupt, and no investment is 100% risk-free, true? So today we are looking at investment options here in Kenya and their current interest rates. I think I can also mention how much you need to invest in each of the investment that I'll be mentioning here today. We'll cover more than 10 investment, I think 11 investment, yes. And because no man is an island, please let me know in the comment section if you have an addition of investments that are available for people to invest in, okay? I also love learning from you guys, yes? So welcome to Study Well. My name is Susan Chukuna, and here we are guided by the philosophy that you have to study to become. You have to study well to become wealthy. And our goal here is very clear: to attain financial freedom, having enough money working for us to sustain our lifestyle, earning enough from our investment, yes? So if this is something that interests you, make sure that you hit the subscribe button and become part of our community, all right? Now, we'll start with low risk investment as we move to high risk investment. And as I mentioned, I have more than 10 investments that I'll be discussing here today, okay? So we're going to start with money market funds, also known as MMFs. So a money market fund is a low risk investment. It preserves your capital. You can top up or withdraw at any time. It offers you liquidity, and you can start with as low as 100 Kenya shillings. Just make sure that when you're investing in a money market fund, or when you're putting your money in a money market fund, make sure that the organization that is managing that particular fund is regulated by Capital Market Authority. That is the only way you can make sure that the money market fund that you're investing in is actually safe. So money market funds, they invest your money in treasury bills, basically short-term investments, so treasury bills and short-term commercial papers, and also on-call deposits, okay? MMFs are currently doing a return between 13% to 5%. This means that we have companies giving 13% while others are giving 5%. So make sure that you're choosing wisely, okay? And these rates change on a daily basis, and they are basically influenced by the central bank rates, okay? So if the central bank rates changes, also the returns on the money market fund, they also change. All right, and here I think it's good to mention that when you're investing, your returns are subject to 15% withholding tax. Now let's move to our investment number two. In number two, we have fixed income funds. These are very similar to money market funds. They are doing a return between, again, 13% to 8%. If you invest here, your money will be invested in treasury bonds and long-term commercial papers. So fixed income funds are allowed to invest in long-term government security. And don't pay so much attention on the name, because this fund works exactly the same way a money market fund does, and this is for the investors. But for fund managers, it will work a little bit different from a money market fund based on where they're supposed to invest the money. But for you as an investor, it works the same way as a money market fund. The only difference is where they invest your money, okay? And of course, they tend to do better than money market funds because ideally, long-term bonds or long-term investment, they do better than a short-term investment. That is, they do better than treasury bills and short-term security. So for both money market funds and fixed income funds, they do automatic compounding, meaning that you don't have to actually manually reinvest your returns. So long as you don't withdraw your money from this investment, they are going to do automatic compounding. Some do daily compounding, others do monthly compounding. So you make sure that you're checking which one does what, okay? Or the investment that you're making or the company that you're investing in, you check whether it does monthly compounding or daily compounding. And again, for fixed income funds, they have 15% withholding tax. Now, our number 3 investment, we're going to talk about treasury bills, and in simple terms, this is where you lend your money, or yes, you lend your money to the government and it pays you back with interest. Usually for treasury bills, you buy at a discount and then you receive the whole amount after the investment period is over. An example is, for example, you buy, let's say, at 46,000 Kenya shillings and you get paid 50,000 Kenya shillings back after that period of investment. So your earning in this case will be 6,000 Kenya shillings. And this is just an example to just highlight how it works. So the current rate for treasury bills goes at 8.12% for the 91-day T-bill. We also have one going for 8.43%. This is for the 182-day T-bill. And then we have 9.7% for the 364-day T-bill. And these are auctioned weekly. So basically what this means is you can buy a T-bill that is 91 days long. So within this period, your money will be locked in this T-bill. We also have a 182-day T-bill and a 364-day T-bill, okay? The minimum investment for a treasury bill is 50,000 Kenya shillings, and this is a low-risk investment. It is also short-term, and you can only access your money when the investment period is over. So if you subscribe to 182-day T-bill, you can only access your money after the 182 days. And you can only lose your money in a treasury bill if the government defaults to pay back the loan it owns its citizens. So this is a safe investment, okay? And I believe if that was to happen, where the government is defaulting to pay back the loans, I mean, it would be in a very bad place as an economy and also as a country. So next, we are going to be looking at treasury bonds. These are medium to long-term investments that are typically offer your interest payment every 6 months, basically semi-annually, throughout the bond's maturity. So if a bond is 5 years bond, it means that you're going to be getting returns semi-annually for the 5 years. So any government security above 1 year is considered as a bond, okay? And the central bank auctions treasury bonds on a monthly basis, but they offer a variety of bonds throughout the year. So if you want to invest, you should regularly check for upcoming bond auctions in the CBK website. That is where you're going to find these, and they announce these on a monthly basis. And in this, we discuss 2 types of bonds. The first one is the most common one, is called fixed coupon treasury bond or fixed income treasury bond, which means that the interest rate is determined and locked for the whole bond tenure. For example, if a bond is 5 years and the rate is, let's say, 14%, you'll be receiving income to your account semi-annually. So 14% of the amount invested, then this is distributed twice each year until now the 5 years are over. For this type of bond, you pay a 10% withholding tax. I think that is important for you to note. The number 2 type of these treasury bonds, we have an infrastructure bond, which works the same way as the other bond, just that the purpose of this bond now is for infrastructure development. Like the government is borrowing money from its citizens for infrastructure. And for investors, this bond is tax-free. And for the infrastructure bond, they are not as frequent as the fixed coupon ones, so you need to keep an active eye on the CBK website, or just follow people who talk about bonds in their YouTube channel. Shout out to Wealth Voice. She does this very well, so you can make sure that you check her out and maybe subscribe to her channel, so anytime that there is an infrastructure bond, you'll get notified, or you know about it. Yes. And the current rates range between 12 to 13%. And for those who are interested, right now we have a reopened infrastructure bond for August 2025. You can check it out in the CBK website. I'll leave the link in the description box where you can actually monitor these. The minimum investment is 50,000 Kenya shillings for the regular bond. But for the infrastructure bond, you need a minimum of 100,000 Kenya shillings to start investing, okay? Now, our next investment is, it has to be special funds, right? So special funds are medium risk investment, and they invest in diversified portfolio to make sure that you're earning some interest or returns from the special funds. They invest in fixed income deposits like government securities. They also invest in stocks. They invest in precious metal. They invest in commodities, currencies, and other things that they think are going to make you money, okay? They are well diversified, and they are currently giving a return of between 17 to 21%. And this is, when I say 17 to 21%, I'm using their target returns, okay? We have seen others do better than these, actually way better than these. We have seen even a 29% return on investment. So that is special funds, and the minimum investment you can do is 250,000 Kenya shillings, and they also have a lock-in period of 6 months. They preserve your capital to a certain level or a certain degree, and it's best investment for growth with low risk. So if you're looking for growth in an investment with low risk, then you have to go for the special fund. So our number 6 investment is something that I don't talk so often about in this channel. We're talking about REITs. These are real estate investment trusts. And for real estate investment trusts, these are basically you investing in real estate without physically owning a property, okay? So we have two types of REITs. We have I REITs and D REITs. So for I REITs, these are income REITs, and they are low risk. The next type of rate is a D rate. A D rate is a medium risk. So when you invest in I rate, you are investing in an income generating property, and you earn through the income generated from these properties as dividends. Like for example, they collect rent from the tenants, and then they pay you back a portion of that as an investor. And the other way that you earn from these is through capital appreciation. So the property owners do valuation of these properties every year, and based on the result, they adjust the value of the units, okay? So they do this maybe semi-annually, so maybe twice a year, they can adjust the price of the units, yeah? And the upside of this is we kind of know that the real estate appreciate with time, so you get to benefit from this as well. So in addition to the dividends, you also your capital also grows. However, the growth is slow, and we require you to invest for long term before you actually see major results in terms of capital gains. Yeah, so the capital gains are tax free, but the dividends has a withholding tax of only 5%. So for I REITs, you're investing in income generating properties. For D REITs, you're investing in development properties. For example, a company can be maybe developing a property, and you invest in it at the initial stages of the development, okay? So when the property is completed, they sell that property and they distribute the returns, or they give you back your money with some interest, okay? So that is how a D REIT works. And for us to see the potential returns on rates, I'm going to use an example. An example is in 2024, investors in Econ I REIT. That is an example of an I REIT here in Kenya. And these Econ I REIT, they own student accommodations. And when they collect money from these student accommodations, they distribute that money to the investors. They earned a total annual dividend or payout of 0.66 Kenya shillings per unit, and the target capital appreciation of around 3%. So in total, the return in 2024 was around 7%. For D REIT, you invest in property that is being developed, and once the property is done, they sell and you get your return. Now to the amount that you need to start investing in this. We have for I REITs, you can invest with as low as 5,000 Kenya shillings. For D REIT, you might need a high amount, maybe like 100K. And for I REITs, they are liquid. You can buy and sell your units at any particular time. So in general, the I REITs offer a return between 7 to 12%. Now, we still have 5 more investments to go, and I thought this would be a perfect place to split our video. The part two will contain 5 investments you need to make massive returns, and I believe it is what people should consider for next level of investments. Okay, and if you have an idea of what they might be, you can let me know in the comment section. Let us make this fun. And make sure you stay tuned for that. Also, for part two for our ETF video is still cooking. It is coming up soon. And if you're interested in special funds, you make sure that you take a look at this particular video and see what you talked about and how you can earn returns, how they work, and how you can earn returns with special funds. Happy investing. See you in our next video.